All right, good morning, ladies and gentlemen. Today is January 11th, 2023, and I am back with another edition of the Wednesday live show, which obviously you can watch on the replay at any time at your convenience, all the way up until next Wednesday. So, um, we're starting off a new year. Kind of interesting. It seems like the consensus right now is that the market is going to perhaps rally in the near term, and we'll look at the chart here in a minute. But the big thing, I think what's going to set the tone for this market is going to be, and this is kind of ridiculous, but I believe it's tomorrow the CPI number comes out, right? And that's the most important number that everybody's been paying attention to lately. Obviously, since um, inflation got out of control, say. And so, the last few months, I believe it peaked around, 9%, 9.1 or something. I don't have that little graph handy right now. I didn't pull it up for the show today. But tomorrow's inflation number is going to probably set the tone, which kind of seems a little silly because earlier this week, yeah, past couple days, and even last week, I think there was a Fed speaker. There's been so many Fed speakers. It's almost ridiculous. It's kind of silly that all these Fed members feel the need, and this has been going on for a long time, as you know, but these Fed members feel the need to come on TV or the media or, give speeches somewhere and talk about monetary policy and what their plans are and this and that. But long story short, the past few days we've been hearing Fed speakers say, they're looking at a couple more rate hikes and they're planning on, I mean, they keep telling the market over and over that they're planning on holding rates all throughout 2023 at their terminal rate or whatever. They're going to reach their terminal rate and then they're going to hold interest rates there, and they're not going to pivot, so to speak. They're not going to lower rates. Obviously, barring a crisis, because every crisis that we've had, the Fed always they always panic and lower rates and throw a bunch of money in, which, by the way, is the primary reason that inflation got out of control. But that's another story we've talked about. Anyway, the funny thing that's going on right now is this whole idea that if inflation keeps coming down, that that the Fed is going to somehow pivot or they're going to lower rates, that type of thing. And they keep saying over and over they're not going to, and it's like the market doesn't believe them. And that's sort of the funny thing that's going on now. And the question of their credibility comes to mind because over the years, everybody has seen as soon as there's signs of trouble, the first thing the Fed's going to do is panic and lower interest rates, and then if it's a crisis, they're going to throw a bunch of money at it. So I saw an interesting chart. I should have saved it the other day, and it was there's always in the background there's the correlation between the stock market and the Fed's balance sheet too, which depending on how you look at it, um, I'm not sure that their balance sheet has actually been shrinking as much as they had said they were going to. So it all comes down to the idea that the market is kind of calling the Fed's bluff in a way, because in the past the Fed a lot of times says they say one thing and do something else. They pretend they're hawkish, but they're not. And so that's a lot to unpack. But anyway, tomorrow's number, it remains to be seen, how that's going to. My guess is the market's going to have a pretty big reaction to it, right? Even though they have over and over have said that they are not planning to lower interest rates in 2023. I mean, they're gonna hold them. They're trying to be really hawkish as far as like getting inflation back down to their goal. So all these years that I've been doing this, I believe that they're just winging it anyway. So, and that's pretty much what I think the market actually thinks, is that they're just going to wing it, and so there's a chance that they're not going to be as aggressive. And then, of course, you get this whole idea of the soft landing, the hard landing, the soft landing. There was a Barron's like months back, a couple of months back, or a few months back, there was a Barron's cover that said that we're already in a recession. Remember, we had the two consecutive quarters of negative GDP growth, and then so there's still a debate about whether we're going to have a recession, whether we had or are in a recession, and all that. And the funny thing about that is that you see all these people saying, "Oh, well, we're going to have just a mild recession, no big deal," that type of thing. And so now they're trying to, create a narrative around, the fact that we're probably going to have a recession, but it won't be that bad, and which is hilarious. And then so the idea that the market, can look past a forthcoming recession. So anyway, what I have today here briefly to look at is this little graph here that I saved. I don't know, I saved this like a week ago or something, 2 weeks, right around the beginning of the year, and this is probably not the best one of these, but it's the only one that seemed pretty comprehensive to me as far as forecasts. So anyway, the S&P's trading right around 3,900 here, right? 3,900's been a big level, as we'll look at on the chart. And I mean, we've looked at for a long time here, but there's a couple of huge levels. Quite frankly, the over and under, in my mind, was really around 4,000, because 3,900 was kind of the level where you'd go below it and you go above it and you go below it. And I mean, 3,900 is definitely an important level, but 4,000 is becoming way more important, and that's a big round psychological number. Look at these Wall Street. This is for year end 2023, and so you got 1, 2, 3, 4. Citigroup, Bank of America, Goldman Sachs, all basically predicting that the market's going to be flat for this year, right? Or I mean, I guess up a little bit. So anymore at these levels, 100 points here and there is not 100 points here and there is like a couple of day move, right? So a couple of days of buying, puts you over 4,000. A couple days of selling puts you, below 3,900. So anything less than like, a percent, or actually anything less than, 1.5%, 2% move is practically just noise in the market these days, just because that's just sort of the nature of things, right? And I saw a data set last year that as far as volatility, it was one of the most volatile years in history as far as the number of days that the S&P moved, up or down over 1% or 2. And so it was crazy volatile. And obviously it was a bear market, this and that. And so, which reminds me of the debate of, when does a bear market start and when does it end? Because in the past, I've seen a lot of people that they start the bear market, they say, well, the bear market started at the peak, right, which would have been like a year ago practically, and then you get a 20% drawdown or whatever, and then it's a bear market. And so the bear market, and then so they draw the bear market starting at like the high and then the minus 20%, but that doesn't seem right to me. So last year, the market, obviously sold off into the new year, and it wasn't until I think May that it was actually down 20%. So to me, that's like where the bear market starts, is once you get a closing level that's 20% off the high, that's the start of a bear market. And I think it was that Sam Stovall guy I saw a while back. said that the average bear market, loses 35% in the last 18 months or whatever. So, but we're kind of in a new world these days. Everything seems to happen faster, the cycles and all that. So we'll see. But oh, so anyway, what I was getting at is if we get enough of a rally here to where the market's up 20% off the low, and I've already seen this. I've already seen like obviously the Dow has outperformed last year. It was only down nominally, and it's just going to be interesting to see what happens. But tomorrow's number is important. Oh, so anyway, if you look at this chart here real quick, um, they're all over the map, right? I mean this 5,000. Wow. 5,000, and of course here you got Fundstrat up at the top. I don't even know who CFRA is, but so you got some really high numbers here. I mean, 5,000 is like, and these couple here are like right back at the highs, the all-time highs, close but not quite. Um, and then down here on the low end, these get some pretty significant sell-offs from current levels. But it's kind of funny because what did we end up, or just under 3,900 to close out the year or something. So yeah, here's the thing: is obviously making a prediction of where the market's gonna go a year out, like where the market's gonna close the year a year out, is it never works out. I mean, these are always like way way off. So it's going to be interesting to see, but I just like to save these just for the fun of them and just to kind of get an idea. Typically, when someone makes a prediction on the market, they take the current level and somehow extrapolate that a little bit, right? Like I'll never forget back in, I think it was like September, October, when Goldman Sachs here lowered the S&P was trading right around 3,600, right? Near the lows, and Goldman Sachs lowered their year-end price target for 2022 to 3,600, like literally when it was trading at 3,600. And then of course it rallied up and closed at 3,800. But um, if these guys are going to make these predictions, they should not be allowed to revise them. Like, which they do, which is ridiculous. And so as the year goes on, expect all these big Wall Street firms to revise their year-end price targets to kind of float with, whatever's happening at the time. Cracks me up. Anyway, so keep this in mind. Where is flat next year on average? I thought maybe I had a different one of these that had like the average or something, but yeah, so that's going to be kind of interesting. So, maybe we rally and then we drop and then we rally and whatever. And so, basically flat. So, right around, I mean, and here's the other thing too, just that 4,000 number is really big. And so, a couple hundred points either way, not a huge big deal. So, let's look at the chart here. So, here's your here's your Wall Street prediction window. Oh, let me get my little drawing box up here. Yeah, I'm so happy about the way that so let's see. Year-end prediction, you know, right right basically in this area here. Let me see if I can. Here's what I wanted to do. I wanted to whoops. There we go. All right. So, this is basically I guess it needs to be over here. Yeah, so there you go. There's your oh wow, this thing acts weird. Oh, I must have done square instead of rectangle. Huh. We close that and see rectangle. That's what I wanted. There we go. Much better. So there's basically your year-end predictions from Wall Street. fall right in that window. My guess is that to get here, it's not just going to trade sideways, right? That would actually be the worst thing that could possibly happen. Is these small tight trading ranges are monotonous. Like this whole sort of congestion zone that we saw right around the holidays. I mean, kind of to be expected. The market sold down, and then between 3,800 and 3,900 for a few weeks almost. It was extremely monotonous. Um, because it's just, when there's no trend in the market, it just kind of sucks, right? When you get into these like sideways things here, for one thing, you don't know which way it's going to break. I mean, you can always guess. And then, typically there's some sort of fundamental type of thing that affects which way it breaks. So, and then of course we have our infamous trend line here. And so this is I accidentally moved my that's close enough for government work. What I was about to say is this is where the S&P 4000, right? I mean 3,900's been a big level just because if I draw a horizontal line at 3,900, we talked about this a lot. There's a lot of support and resistance at 3,900, but 4,000 is the most important level, if you ask me right now, because that's where this is the 200-day moving average, by the way. I got the 200-day moving average on this chart, which is the blue line, and the main trend line, which give or take a few pixels, but interestingly enough, we're getting kind of close to it. And so, there's been a few times, but if you recall, each time that the market gets up near this trend line, like back here in the summer, and even more recently in early December when it got up there, by the time it gets up there, the sentiment has generally turned pretty bullish, and people expect the market to go higher, basically. But and hey, the one, two, well, I won't say third time's a charm, because the third time there was that fake out, which we talked about at length last week, but we're getting pretty close here. So if the CPI number comes out good tomorrow, and exceptionally good, and people think, well, geez, maybe the Fed doesn't need to raise 50 basis points, in February and 50 basis points in March. Maybe they'll, if they see some good data, maybe they'll only raise 25 and then hold off or something. And so, that whole concept that the media has been drilling into everybody's head about a Fed pause or Fed pivot or soft landing, that still has a lot of capability to affect what happens here as we get to like the main area here to break out of this trend line. So the other thing, assuming that the market is going to rally, assuming the market wants to rally, and I mean, here's the thing: is we did, I can't tell you that we're looking at a rally up to 42.50 or anything, because I just don't know. I mean, a lot's going to depend on the reaction tomorrow, and now that the new year's sort of gearing up or whatever, we're going to be looking at earnings season, and of course, the narrative around that is that, earnings are going to suck, but it's just temporary, and so the market likes to look past, bad news and say, well, it's priced in. But the thing of it is, what I was getting at a second ago is that this congestion area here was pretty darn important, right? Because, I mean, we're talking and of course it was the holidays, but we're talking like 3 weeks of consolidation in an area, which, quite frankly, I mean, that's the longest consolidation period you see on the chart. I mean, there was one back here that, seemed pretty monotonous, and then it broke to the downside. But this one was even longer, So there's a huge base built here, and you can't see it on the chart, but one of the indicators, or the indicator I happen to have below on this chart right here, is the good old trusty MACD, which is just now turning positive down here, which is also sort of a positive sign. Now, here's the thing is, like, what you're looking at here is tons of overhead resistance, right? Like all this, trading area in mid-November until mid-December, all that's kind of overhead resistance too. So, I mean, just because the market's kind of got a little cup forming here, I mean, that's the positive part of where we are now. You got the MACD turning positive, and so, but boy, this we saw it get rejected back here right at the 200-day, the convergence of the 200-day and the downward sloping trend line. And I mean, we're literally right there too. And so, we could see the same thing happen, or we could actually see a break above that and then, see what they can do as far as chewing through this resistance. The market likes to do weird stuff, like break out and then just take off and just bust right through it. That would probably be better than like trading up and down around 4,000 for a long period of time. So um, anyway, so some positive technical signs as far as the potential for an upswing, but the question is, well, for one thing, until I see what happens tomorrow, I'm not sure that I trust anything. I don't know how much follow through I expect from this particular rally. So, there's I could sit here and make the argument both ways for, the market rallying, breaking above the 200 in this trend line and continuing to rally up. I could make that case. Anybody could. You could have a, debate. You see it all day long on CNBC. That's what these guys do. They come on and they say, well, we think this or we think that, and so there's plenty of like bullish cases and bearish cases. And it seems like, and the market doesn't necessarily care one day, and then the next day it cares about something. That's always cracked me up. So the sentiment, the longer term sentiment, I think, is pretty negative. But the funny thing is that, when the market goes down and when you hit a bear, a theoretical bear market, then the sentiment does turn negative. It's because people are losing money in their portfolios, right? And, geez, if they were holding tech stocks or ARK or, those kind of things, I can't do a show without bringing up ARK, which is getting a nice little bounce, by the way. And now that, I mean, it got below $30 for, very brief period of time. And I kept thinking to myself, it's probably a buy just for a dead cat bounce, especially going into a new year. And so, yeah, but I mean, this is extremely dangerous because, well, you see this day here, like it looked like it was going to bounce into the new year, and then it had that big gap up and sell down right on the first trading day of the year. But yeah, the fact that the numbers are so small, see, that's another thing too. Like when you got a stock that goes from 100 to 5, it can easily go from 5 to 10, but the chart still looks like garbage. So it's going to be interesting to see what happens here. Like ARK's starting to approach resistance, but you're getting a lot of dead cat bounces. Some dumpster diving, people like to call it, like Coinbase. Hit some new all-time lows here. I mean, what did this thing IPO at? Hang on, I should have left the chart all the way back there. IPO'd at 250. Opened at 300 to 400. And and then the thing, so $300 to 30 something, a bounce from a rally from 30 to 40 is humongous. Well, heck, we're almost at 45 here. So, but anyway, the idea is that these stocks that have been absolutely destroyed. Let's look at Zoom. Yeah, Zoom. I mean, this was what a almost $600 stock down to $600 down to, 65 or whatever. And so some of these stocks, I think, I wouldn't, be surprised if hedge funds and institutions of that are like scooping up a little bit of these things, thinking that, hey, maybe they did get overdone to the downside. But Goldman Sachs has like an index of money losing tech stocks or whatever they call it, and that's what a lot of these ones are in. But the potential there's potential for some decent trading rallies in these. But what I was about to mention, last thing I'll mention here, and I'll wrap it up, is that the question of, did we really have a bear market? Um, the Nasdaq 100. I mean, the Nasdaq 100 had pretty much a real bear market, right? I mean, that's from 400, down to whatever the lows were, just even where they are now, from 400 to 275. That's a real, I would consider a bear market. And back to, I'm going to go back to ARK for a second and pull up the weekly chart. Yeah, so, there's a lot of stocks that have a similar pattern to this. They just went bananas to the upside, went parabolic, and then they crashed all the way back down to somewhere where they sort of started, well, I could have pulled that Zoom up, but here's another one that comes to mind, Roku. $50 to 500 and back to 50. So that's what that's what like the .com implosion looked like. That's what back in 2000 or whatever. That's what basically how what the Nasdaq looked like back then. It went parabolic and then crashed all the way back down to where it started, and you get that sort of this sort of pattern. And there's tons of these things. I go back to Zoom because that's it's got sort of the classic pattern. Parabolic move, crash all the way back down to where it came from. Some of the software like this stock, on the way up, I mean, I kept looking at this thing thinking, oh my God, it's amazing. So, these are basically like, these are, .com implosion, bear market, South Seas bubble bursting patterns, but it's only a portion of the market. See, that's the crazy thing is, the S&P, the overall markets, even the Nasdaq, doesn't look like this. But there's a subset of stocks that like they had not even a bear market. I mean, they basically had like a bubble and a crash. And so everything's kind of weird because if you were holding the wrong stocks, like Cathie Wood was, and averaging down, doubling down on them. And speaking of, one last one I wanted to look at was Tesla, because this is a weekly chart, of course, because I mean, here you got a stock. It went parabolic, obviously, from, here's the pandemic, right? There's the pandemic sell-off. But anyway, you got a stock that went parabolic. It basically went from around $50, say, to 400, and now, from 400 to 100, that's a pretty big haircut. That's that's a bear market. So it's a very, not bifurcated. It's not really the word I'm looking for, because like I say, there's and I don't know. It's hard to say, like, I don't pay that much attention to this stuff because a lot of it, it doesn't matter that much. But if you took like the Wilshire 5000 or something, and you said, okay, how many of those stocks, how many of the total market is, is down 20% or more for their highs right now. And so the VTI, I guess this is probably the broadest market index there is. So you could do I haven't done the math on this, but maybe I will. It would just be interesting to know on the VTI what the, what's weird too is that you would think that an index is like this, the total market would be the index that everybody focuses on or something. I don't know. I mean, and plus this is probably, I'm sure that that well, this is probably, I don't know if it's market cap weighted or equal weighted or what, but anyway, it looks like it was probably market cap weighted, but it's supposed to be the broadest market index there is. Speaking of which, Vanguard's other index that is supposed to be the broadest measure of everything is, wow, look at that. Yeah, this is kind of nuts because I mean, this is the bond market, right? The total bond market. And every time I look at that pandemic, couple of weeks there, it just blows my mind. It kind of skews the chart. That was quite the anomaly. Um, but you've seen it. 2022 was one of the worst years in history for a 60-40 portfolio. Here's the thing is that this thing's rallying back pretty nice, quite frankly. And so, I don't know what to make of it. I'm not a big I'm not real big on following like what the bond market's doing, but I guess my point is that the S&P 500 and these other indexes, they're all kind of in their own little world. This to me is the most important one. And back to that day, well, you can on the weekly charts. I mean, it's good to look at a weekly too. You look at a weekly chart, and um, we're getting towards like sort of the do or die time. Getting towards the do or die time. The 200-day moving average is just above the current price action, which is a good reference point. But you can obviously see that just because the market goes above the 200-day moving average, I mean, you had a few weeks over here, and then pokes above it. That doesn't necessarily mean that it's just going to continue higher. So, I mean, the slope of the 200 days down, typically, when the slope is down and you poke above it, it's not as meaningful as, obviously when it's sloping up and you test it to the downside and then bounce off of it. So, the big thing here is going to be this little, I don't know if, well, here's the apex. This little area in between, major overhead resistance of the downward sloping trend line and then all this sort of, this level here. What is that? Let's call it, well, call it 4,100, right? Like this high right here is right about 41, right about 4,100 this day. Yeah, actually, look at the top there, 4,100.96. So I'm going to call 4,100, just move that up a little bit there. I'm going to call that the big level of resistance on the upside there. So yeah, so this little sort of space between the 200-day moving well, actually it's between the downward sloping trend line and 4,100. That's going to be the interesting part. So, and of course there's always fake outs. You break this trend line and then fall back down or whatever. So we'll just have to see what happens. But before we even get to that, it's going to be about tomorrow, right? And then of course tomorrow and then the next day, because the market's got to digest everything. So you'll get some sort of knee-jerk reaction tomorrow, and then you will get whatever the close is on Friday is going to probably set the tone going forward. And then of course we're going to be getting right into earnings season, which is also going to be interesting. So, there could be fake outs. This thing could rally up or whatever. Inflation's coming down. Then earnings start to come out and and it just falls right back down into this range. Big support levels down here, though. See, that's, there's I don't want to add another line, but I could. This whole zone right here, huge support on the downside now. So it's going to be interesting to see what happens, but we're kind of still in wait and see mode right now. So let's just wait and see. And so I will see you back here next week, and we'll see how things played out at that point. Thanks for tuning in. See you here next week, same time, same place.